Okay, then let's get going. Good morning, and thank you for joining us for our final session of our Farm Filings tax series. I believe this is the event that so many of you have been waiting for. We're going to be joined this morning by Neil Narveson of Compeer Financial to talk with us about how to handle the changes to our 2020 taxes and what we need to do to get prepared to submit those, file those. I do want to give you the standard Zoom rundown. If you're not super familiar with Zoom, please keep your video and audio muted during our presentation. Neil's going to go through his slides and explain a lot of things to you. If you have questions while he is presenting, you are welcome to type your questions in the chat box. You can find the chat box by moving your cursor to the bottom of your Zoom screen. A little toolbar should pop up and there should be a little chat icon. If you press on that, a box should open up and you can just type your questions right into that box and we will answer those at the end of the presentation. So feel welcome to add questions as we go. And at the end, if we have some time, we will allow you to answer your questions verbally. I am your host this morning. I'm Cassidy Delordo Blackwell. I'm the Farmer Training Program Manager here at the Land Connection located in Champaign, Illinois, and serving farmers throughout Illinois and beyond. Our mission is to train farmers in resilient restorative farming techniques, inform the public about the sources of our food and why that matters, and work to protect and enhance farmland so that we and generations to come will have clean air and water, fertile soil, and healthy, delicious food. You can visit us online. I'm supposed to move forward my slides, but I did not. You can visit us online at thelandconnection.org. You can sign up for our newsletter there to stay up to date on all of our goings on. I'd also like to extend a large thank you to the Roots to Farm Alliance for supporting this series. The Roots to Farm Alliance is a collaborative effort committed to providing resources to farmers growing their businesses in the Chicago food shed. They have a lot of resources and events, and you can find out more about what is going on at Roots to Farm by visiting roots2farm.org. And finally, a very big thank you to our 2021 farmer training sponsors. Without their support, we would have a very difficult time making all of this work happen. And an especially large thank you to Compeer for being a sponsor and for providing us with your expertise in this webinar series. And now we are ready to move on to the main event. This morning, we are joined by Neil Narveson from Compeer Financial. Compeer Financial is a member-owned farm credit cooperative serving and supporting agriculture and rural communities. They provide loans, leases, risk management, and other financial services such as tax and accounting throughout 144 counties in Illinois, Minnesota, and Wisconsin. Neil has joined the farm credit team just this past year. He lives in Iowa County, Wisconsin. Neil has a Bachelor of Business Administration and Accounting and over 25 years as a CPA. We are very grateful for Neil sharing his wealth of knowledge and experience. So I'm going to pass it over to you to take it away, Neil.
Thanks, Cassie. Nice to be here today. Just going to do a little update on tax update and planning for you today. So why don't we get started here? Cassie, you can go on to the next slide, please. So one of the new things for 2020 is charitable giving. There's now a $300 cash donation that you can take. It's above the line that you don't have to itemize. So this is if you give, let's say, $600 to the church or whatever charitable organization you want to. And if you don't itemize anymore because the standard deduction is so high, you were kind of losing out on those deductions for those charitable giving. So they created this $300 cash donation that you can take before without having to itemize. as long as you've given that money to a charitable organization. So for $300, that's for married or single couples for 2020. And that would equate to a 12% bracket, tax bracket would be $36 in tax savings. And a 22% bracket would be $66 savings. And there'd be some possible state savings there as well, depending on how your state handles it. Like I said, this $300 is the same for both single and joint this year. But starting next year in 2021, there'll be $300 for single and it'll be $600 for joint. So it doubles up for the joint next year, but currently it's still $300. As I was talking about, the standard deduction is quite high since they've changed it the last couple of years. For a single person, it's $12,400, and for joint, it's $24,800. So we haven't been able to see very many clients itemizing any longer because that joint number is so high, and along with the single is high. We've also capped out that state and local taxes at $10,000. So the vast majority of time in the past, when we itemized, it was because of the state and local taxes between your property taxes, your income tax, and so on, would get you to itemize. But now putting a cap on that and increasing the standard deduction, very few people are able to itemize. Next slide, please. So for retirement plan distributions for this year, they ease the distributions for retirement plans, okay? Because of COVID-19, they eliminated the 10% fine if you took out distributions from your retirement plans before your age 59 and a half. So in 2020, you could take out that up to $100,000 from your retirement plan, not pay any penalty on it. It's waived for 2020. These are for distributions from a 401k, 401(b), and IRAs. Tax on these distributions, you're still getting taxed on it, but you can split it out over and distribute it over 3 years if you want to, or you can also recontribute the amount that you took out within 3 years to avoid the tax altogether. So if you took out the full $100,000, as long as you paid that $100,000 back within 3 years, you avoid the tax altogether. Or else you can pay the tax and split it over 3 years, like I had mentioned. Next slide, please. So one thing that you can do to help minimize your tax liability is contribute to 529 plans. These have been around for quite some time, and it's a great opportunity to fund your future education expenses for your children and grandchildren, and to pick up that state deduction. As you can see, it depends on what state you're in. Minnesota is a $3,000 maximum joint savings credit, and Wisconsin is $3,340 per beneficiary. So for every grandchild, a child you put in, you get that credit if it's done to the state plan in Wisconsin. In Illinois, it's $20,000 per beneficiary. So it's really nice down in Illinois. If you're located there to put money in, you get that credit for that beneficiary. Now, the one thing that's nice about this is these all grow tax-free as long as you're used on education expenses. So whatever you put in, you get that deduction. Any kind of increase in the plan, excuse me, gets a deduction as tax-free as long as you pull it out to pay for education. In the past, it was only able to use for college education, but they changed it here recently that now it can be used for K through 12 educational expenses as well. If you are sending your kids to a private school, they would be able to use this. Some other changes with the CARES Act. There's a change in the NOL rule changes. They were limited to using 80%, and farmers could only do a 2-year carryback. But they changed that with this CARES Act that came through. Now everyone for 2018, 19, and 2020 can do a 5-year carryback. And the reason why they did this was an intent was for some businesses to be able to go back and amend those prior years and possibly get some tax refunds. So that was a change that we have to be aware of. That it's now a 2-year now a 5-year carryback to look at And if you don't want to do a 5-year carryback, you have to waive that or elect out of that carryback. Otherwise, it's automatic. Some of the other things is there's payroll credits available for employers affected by COVID. So if you have payroll that's had some, you're affected by COVID, you may have some payroll credits you can take from there. Also, the recovery, rebate, and economic impact payments, those $1,200 payments that we got last year, and then the $600 at the end of the year, beginning of 2021. These are all based on 2018 or 19 return, even though it's a 2020 rebate. So there's some questions that have come up from different people over time here, and I just want to cover. So let's say you have a dependent of yours that became independent in 2020. So they will get the credit, the $1,200 credit and the $600 credit when they file their 2020 tax return and mark themselves as an independent on their return. So even though, like myself, I have college-age kids, if they wanted to claim this off as being independent, they hadn't gotten the rebate payments yet because they were over age 17. But if they claim this off as an independent on the 2020 tax return, they would be able to claim those credits and get it paid out with their tax return. One of the other things that people are asking is what happens if their AGI exceeds in 2020 exceeds the limit, but in 2019 they were fine and they got the payout, the $1,200 credit and the $600 payment also. They will not have to pay that back because they exceeded in 2020. They are free to keep that money. Just likewise, if you had higher income in 2020, I'm sorry, if you had lower income in 2020 and higher in 2019, 2018, you didn't qualify because of that. Let's say you lost your job in 2020 and all of a sudden now you don't have the income there anymore and you qualify based on your AGI, you would be able to pick up that credit, the $1,200 and the $6 on the 2020 return. Also, for those parents who kids aged out in 2020, in other words, they turned 17 in 2020, they had received the $500 credit because it was based off of the 2018 and 19 tax returns. So even though they turned 17 in 2020, they wouldn't have been eligible. They will not have to pay that credit back for those kids that aged out. The other thing we're seeing is people are asking, well, about children born in 2020, we didn't receive any credit for them. You will on the 2020 tax return when you apply or when you file the return, you will get that credit for that new dependent. And the last thing I want to cover on this is divorced parents and they're alternating their dependents claim in 1 year and not the next. So one parent claimed a child in 2019, they would receive the payment for the child in advance on this. Now the parent switches and the new parent picks the child up in 2020 and they're wondering if that parent would also receive, and they should receive that credit also on their tax return for that dependent. Next slide, please. So I want to talk about depreciation here for a second. So 2020 depreciation election limit, the most you can do to elect for 179 is $1,040,000. The phase out starts at $2,590,000, and that's a dollar for dollar reduction. What that phase out means that if you make enough asset purchases more than $2,590,000, for every dollar over, it reduces $1 in that amount that you can elect for 179 expense. So it goes up to the total phase out ends at $3,630,000. Now, if anybody has bought that amount of assets above and beyond that phase out, they should really consider moving some of these purchases to a lease. That way, keeping you under the limit and allowing you to take the Section 179. One thing you may also want to keep also in mind is if you max out on your 179, there is bonus depreciation still available on new or used purchases with 20-year life or less. And the one thing behind this is, though, it's not as flexible. With bonus depreciation, it's an all or nothing per class. So let's say you have 7-year class property and you want to take bonus depreciation on it, you have to take bonus depreciation on all of the 7-year class assets that you purchase. You can't pick and choose the individual assets. It has to be the whole class. So it's an all or nothing, and it sometimes causes you to be more than what you wanted. So that's the main difference between depreciation, section 179 and bonuses. 179, you can elect individual assets. You don't have to have each individual class, and you can only do a partial on an asset. If you want to do $10,000 on one asset, or if you want to do 50,000, you can elect how much you want to do. Whereas with bonus, you have to take the full amount of the asset, and also for the full amount on the class of the assets, all the assets in that class. Next slide, please. So one thing we want to talk about here is like-kind exchanges. They are no longer, for personal property, it no longer qualifies. For real estate, it still qualifies, but it's not as easy if there's buildings involved on it as if it's just bare land for bare land. So when we think about like-kind exchanges in the past, a lot of it was when you traded in a piece of equipment, it was considered a like-kind exchange. You didn't take the gain on the trade-in. So now with the rule changes, machinery trades are considered sales. So that can lead to sizable gains. This value of this gain is added to the boot price or the cash price you paid for the new asset. So the client has a larger value to depreciate. So it's the maximum amount. Let's just give an example here. You trade in a tractor, you get $20,000 for it, let's just say, let's make this easy. And you're buying a new tractor and you pay $20,000 cash plus the trade-in. So your basis and the new asset would be the 40,000, the 20,000 for the boot that you paid and the 20,000 for the asset you trade in. This leads to a bigger negative Schedule F to offset that gain, which is showing up on the form 4797 for a sale of assets from the trade-in. Now, one thing you need to caution on, think about is if you have a new lease, and instead of purchasing it, if you have a high value depreciated out piece that you traded in on that lease, that can lead to some tax issues because you only have the lease payment, which could be quite a bit less than the gain on the sale of the trade-in. So you're only making the lease payment for the expense rather than getting the amount, since you wouldn't be purchasing it. And then but you still have the gain on the trade-in. So it would cause a huge tax problem if you do it that way. Now, one other thing with the transfer, the like-kind exchange of 1031s of farm property, issues with single-purpose buildings and equipment. The new property that you're getting has to have those same types of property as a sale needs to be split between different classes of property. In other words, buildings and land. You have to split the purchase price between the buildings and land, and the new piece of property has to have the same buildings, same land, pick up on that. Next slide, please. So income. This year, there's been quite a huge influx of income, and most of it's due from government payments, either from the FSA, state, and other special payments added to the income that you're not able to defer. You have to pick up this year. Other income that we're seeing this year is coming from insurance. So the DRP for milk, crop insurance. Just be aware that if you deferred any crop insurance from 2019, that's going to have to be picked up. And obviously from the PPP loan program is also in there. One thing I want to talk about is that the government payments are coming in. We're seeing quite large amounts that are not able to be deferred coming from CFAP 1 and CFAP 2. And we're also seeing a lot of ARC and PLC crop payments and DMC milk payments on top of that. We've been seeing and hearing that a lot of the income, approximately 40 to 45% of income in 2020 is coming from government payments alone. So it's making a huge difference in the taxable income on the Schedule S for farmers this year. Now, the PPP loan program, that's still ongoing, but we're running out of time here. It's only got about a week to go. It's the end of March is the deadline for applying for a PPP loan if you have not received one yet, or if you want to receive a second one, or if you did receive the first one, you don't want to redo it because you didn't get the maximum amount. But that all has to be done by the end of March 31st. So that is coming up fast. So if it's something that you're considering, it should be done as soon as possible in order to make sure you get in there and get that. Next slide, please. Okay, so maximizing your income tax savings. Some things you can do is you can do income averaging, and I'll get into that a little bit. There are 199A deduction. So for income averaging, if your 2020 income is greater than the previous 3 years, we use the tax brackets. So you use the tax brackets from the previous 3 years, which can provide a lower tax balance. Now, this isn't going to save on self-employment tax, state taxes, and real estate. It is because none of that is allowed to be income average. This will just strictly save on regular income tax on it. The 199A qualified business deduction is 20% off of taxable income. Now, the taxable income on there, it's the qualified business income that gets it. And the deduction is 20% of that QBI from a partnership, S Corp, or sole proprietorship. QBI is defined as the net amount of items of income, gain, deduction, and loss with respect to the trade or business. Now, certain types of investment-related items are excluded from QBI. Some examples of that are capital gains or losses, dividends, and interest income, as are the employee compensation and guaranteed payments to a partner. Now, one thing that also does not qualify, if you think about it, is cull cows. If you're dairy clients, you're a dairy farmer, and you have cull cows, those are capital gains are not eligible for the 199A QBI deduction. Taxpayers whose taxable income exceeds a threshold amount of 163,500 or 326,600 in the case of a joint return are also subject to limitations based on the W-2 wages and the adjusted basis and acquired qualifying property. So for partnerships and S Corps, the deduction is taken at the partner level or shareholder level. Business losses affect the following year's calculation of 199A. So if there is a loss on the business, the calculation for next year will be reduced because of that. There's a carryover of that loss into the next year's calculation, reducing the amount of 199A calculation for the following year. And C corporations are not eligible for the 199A deduction. Next slide, please. So some things to think about for tax planning. You know, we're in some unusual income and unusual times. We're getting income in that we haven't seen before because of all the government payments, to at least to this extent. And it's in some really strange times this past year, that's for sure. So you may have some income bunching due to the added government payments. Will it be lower in 2021? Possibly, we don't know. We're hoping it will be, because that means things are getting back to normal, but we just don't know. Some other things you can do for tax planning purposes is prepay your expenses. Now, prepay expenses can't just be a down payment on seed or fertilizer, etc. You have to pay for the full amount in order to get that deduction. You can also defer your grain sales if you have grain sales to next year, but don't do that just for tax planning, make sure it makes sound business and marketing decisions to do it. Never let the tax drive the train, if you want to call it that, but just keep in mind, tax planning for the, excuse me, for, making good business decisions. Also remember, you got your retirement accounts. You can max those out or make more contributions into that. Be aware if you're on the marketplace health insurance, that if your income is higher, you're probably going to have to end up repaying some of that if you didn't adjust throughout the year. So there could be a marketplace payback that's there to keep in mind when you're doing your taxes. Also, if you haven't set up anything, you have employees, you set up a retirement plan to make that deduction there for 2020 yet until you have to file your return. A lot of farmers are carrying NOLs, unfortunately, and they will help with the federal and state taxes, but the self-employment taxes could still be an issue. You could have Schedule F right now, you can have a major income this year, but it's offset by that NOL, so your income tax is showing nothing as far as income tax, but there's still going to be self-employment tax that you're paying on that huge income on the Schedule F up front. So just keep in mind on that. Also, just remember that your tax situation is not based on your checkbook. If your checkbook is showing lots of money, doesn't mean that you can go ahead and pay off that debt and expect a tax deduction, because you're not going to get a tax deduction if you're paying off debt. So you kind of got to take into planning the effect across all boards between cash flow, what you got going for the business, for the farm, and also what's going to do the taxes going forward. And with that, I am done, Cassidy. Do we have any questions?
Excellent. Thank you, Neil. Let me join. It looks like we have one question. If you guys have questions, I know that was a lot of information. Please feel free to drop any questions you have in that chat box. Michaela has one question. Would single member LLCs be eligible for the 199A deduction?
Yes, they would be. It's part of they are part of the only ones that aren't eligible for the 199A are C corporations. The single member LLCs still qualify for 199A.
Excellent. Rachel asks, how should an in-kind product donation be handled? If the farm donated produce to various organizations in the last year, how do you handle that?
If they donated the product, but they've also taken the expenses for that as an expense, you're not going to get that deduction for the charitable, because they've already taken the deduction for the seed, the fertilizer, all that stuff going forward. If you're making those deductions on the return already, you can't double up and take a charitable deduction based on the product that was given, unfortunately.
Okay. Well, we're still waiting on some questions. Our director, Jacqueline, has put in the chat box here. If you are looking for more resources, we do have a lot of resources on our website, and the recording of this webinar will be available there after we finish up today. Michael asks, if an insurance payment for storm damage is paid by the insurance company in 1 year, but the work and expense occurs in the next year, how is that insurance payment categorized?
Insurance payment for storm damage is not going to be income to you at all. So you're not going to include that in income, but you're also not going to include the expenses unless there's more expenses above and beyond the proceeds of the insurance proceeds. If the insurance proceeds cover all their expenses, then you're good. You don't have to worry about anything. If you have more expenses above and beyond the proceeds, then you pick those up as expenses in the year that you incur them.
I hope that helps you, Michael. Yeah, we had a lot of we experienced a lot of challenging weather last year around here. Hope
That's that lovely 2020 feel, you know, or
yeah,
2019.
it was, it came
Yeah.
at you from all possible angles.
Yeah.
Okay, let me see. If the farm receives donations from people, how do you handle that?
The farm receives donations from people as far as talking cash donations, you know, that's
Cash.
not, I've never come across the farm receiving donations. Are you talking time? If it's time, then it's just nothing. You don't have to worry about it. If somebody's coming out doing some work for you and they're donating their time, there's nothing you need to worry about. There's no tax consequences. You know, if they're given the farm money, I haven't seen that personally in the past myself, so I'm not exactly sure how. I'd have to look that one up. I don't want to tell you something and not be correct. So I have not, in my years experience, I've not run across that. With the money, I've seen more people donating their time, coming out and doing work. And that, like I said, you don't pick up anything on.
And what if it was like a donation of seed or like soil amendments? Would that make a difference?
That would just, you're not going to pick up any expenses. You don't have to worry about income. You don't have to add it to income because if it's seed and you're buying less seed, your expenses are going to be down. So you're really picking it up there. Same thing with fertilizer or anything like that. You know, your expenses will be down. So you're really picking up it there. You don't have to pick it up as income.
Gotcha. Oh, okay. So yeah, Rachel, so I still think I might need some more clarity, Rachel. She says that so it is cash donations through like an online app to the farm bank account. So I don't know if that creates any other liability.
Okay, so it's a cash donation and it's set up like a GoFundMe, I'm assuming is kind of like what she's saying.
She said it's a quick pay Zelly. I think it's like similar like PayPal.
Right. But is it set up through, was it paid? I'm thinking, you know, the thing I'm leaning towards is if it's like you guys all know what GoFundMe is. It's like where somebody is having some difficulties and somebody sets up a GoFundMe. That's not income to that person. So I was thinking as long this line way too is, you know, the farm was experiencing tough times because of the COVID and 2020 and everything going on, that the person is donating money to it. And I would expect it to be the same way based on that experience. But that's kind of where I'm going with that. I'm not sure 100% on that, but that's the way I would read it. Because if it's a donated cash in, you're not going to have to, yeah, I correlate it to that whole GoFundMe for an individual that you don't have to pick it up. I don't think it's taxable income to them, but I'm not 100% positive that I would want you to double check that or talk to your tax advisor. Or if you want to contact me outside of this, I can do a little research for you quick and see for sure. Was that Rachel you said, right?
Rachel, yeah.
Yeah. So if Rachel wants to contact me, she can. That's fine.
Okay. Go for it, Rachel. You've got free reign. I'm going to come back to this insurance question and hit this other charitable donation question. Nancy asks, if the cost of production is $1 and the sale value of the product is $3, you can't take the $2 loss as a donation. I'm not sure I understand.
No, you cannot.
Okay. And is a payment from a life insurance policy, is a payment from a life insurance payment taxable? So I assume if
No,
life insurance.
life insurance is non-taxable.
Okay. Okay. Again, if you have more questions, please feel welcome to drop those in the chat. Again, Jacqueline has dropped another great resource from the Land Connection in here. We have a new online course, Financial Risk Management for Specialty Crop Producers. It's a self-directed online course with a lot of text and videos and quizzes, and it has a companion textbook that you can download on our website. And if you want a hard copy, we can mail you one for free. There's a form on our website that you can find. I have to believe that there are more questions about taxes, but I can understand if your head may be spinning also. Yes, and another shout out. We will also have a legal online course workshop series starting next month. It's called Discovering Resilience. It will have it's being led by Farm Commons, which is a legal farm group out of Minnesota. And it will be a sort of combined self-directed interactive sessions with work to do on your own beforehand, and then a 2-hour meeting once a week with Farm Commons lawyers and other farmers to discuss what you've been learning. So you can sign up for that by going to the link right there in the chat. And we've still got some time if you have more questions. Rachel, is the due date April 15th or May 15th right now?
Actually, it's May 17th because if May 15th falls on a weekend. So
Okay.
they have extended the tax filing deadline from April 15th to May 15th, but I guess that since it's 15th falls on a weekend, goes that following Monday, which is May 17th.
Okay, great to know. So everybody, you got a little bit of time until May 17th, but mark your calendar now.
Don't wait till the last second.
Right. Nancy says not for businesses. Is there a different filing date? Are there multiple filing dates?
There are. I thought we were talking individual, like a Schedule C or Schedule F. So there are multiple. The extended deadline is strictly just for individuals.
Right. And I know that the if you were like an S corp and you got the automatic extension, you have until September.
Right, September 15th.
Yeah.
Yeah, they didn't extend that one because most of the businesses were already due, on March 15th. And if they extend, they would have done an extension anyways. So they didn't extend that out.
Sure. Yeah, that makes sense. Well, if you have more questions, please let us know. Otherwise, we may end up wrapping this up a little early this morning. Do you have any just general tips for approaching your taxes and not being overwhelmed?
It's as far as approaching it right now, it's kind of too late to do it, but I would recommend going forward. The more organized you can keep your taxes and records and paperwork throughout the year, the easier it'll be to do tax returns. Either you're doing them yourself, or if you give them to your tax preparer, they will greatly appreciate it being organized and going forward. Just sit down and slowly go through it this time of year. Everybody's in a rush, and I understand everybody's busy, but if you rush through things get missed, or some things may have been written down incorrectly. So take your time going through it. I know, as I said, we're all busy. It's that time of year where farmers are getting out and weather's changing and we're getting busier, but it is important to get those taxes done and done correctly. We don't want to miss, as a tax preparer, we don't like missing any information, because it could limit to lowering that tax liability, limiting credits, and increasing your tax liability. So just take your time, go through it slowly, methodically, and get it done. But I would recommend doing it throughout the year rather than waiting to now to organize everything.
Yeah, excellent call. And if anyone missed our last 2 sessions with Dan and Christy about record keeping, those are available on our website and on our YouTube channel. Lots of good information about how to keep yourself on track to have all your records ready when you get to this part of the year. Well, I feel that maybe everybody's heading out to the fields this morning, so wrap it up. I'm gonna share my screen just one more minute. If I can find the button. There we go. Okay. Would just like to say thank you so much to Neil for sharing with us this morning. And thank you quite a bit to Compeer Financial for supporting us and for lending us your expertise these past 3 weeks. You can find a wealth of resources and information at compeer.com. They also have a variety of educational events on there that you can access on their website. You can also check out Roots to Farm. A very big thank you to Roots to Farm for also helping us to put this on. Check out what they have going on at rootstofarm.org. I do have a quick poll. Oh, I can actually launch it today. I'm going to launch, so just take a minute. It's just a couple questions about how our presentations were today, just so we know how we're doing. So if you can take a minute to click those buttons, we'd appreciate it. And again, I'll be sending out a recording and the slides to you all after this, and you'll be able to access those on our website at thelandconnection.org. So thank you so much for joining us, and thank you so much, Neil. Really appreciate it.
No problem. Thank you.
Have a good rest of your day.